Building a long-term investment portfolio. Financial planning, which is what we're talking about. Everything is financial planning when we think about our financial life. It's going to end up with one of two situations for you. Door number one, you're going to be able to afford to do everything you want in life. Door number two, you're going to miss out on doing things you want in life. Now, with financial planning, with forethought and acting with intention and paying attention to what's going on around you, I'm not saying you're guaranteed to get through door number one. I'm just saying that there's an increased chance, an increased likelihood of going there. And that's what I do for people. And here's the way I look at financial planning. 4 different areas, those 4 columns across the middle. Today, we're talking about building your long-term portfolio. That fits into the make it grow column. So that's just one area. Investments are just one area of financial planning. They're not the whole thing. And here's the process I go through with clients. And I want to show you this because I want you to see how far down the list investment strategy and implementation really is. There's a lot of other things that are just as important or even more important. Number one, understanding where you want to go and what you want to do in life. If we don't have that, we can't build the portfolio to take us there or the other strategies to get us there. So that's basically the layout of where we're at, what we're talking through today in building our long-term portfolio. Now, what does long-term mean? To me, long-term is 5 years or more. So any money that we plan to spend more than 5 years from now, that should be in our long-term portfolio where we're going to ride the ups and downs like we're seeing in the markets these days. We're going to ride through those in order to have more money to spend in that period, 5+ years from now, could be 20 years from now, could be 30 years from now, but a long time from now versus what we have today. Any funds that we're going to spend in less than 5 years, we want that in a savings account or something really, really safe and liquid. Now, every dollar you have should have a job. And those dollars that you're going to spend in the next 5 years, their job is to be there. They just need to be there. Their job is not to grow. So you're not going to earn much return on that. And that's okay, because the job of that money is simply to be there to allow you to do those things you planned on doing in the next couple of years. Now, why do we talk about a long-term portfolio? Well, because we cannot predict how investments are going to behave in the short run. No one can. So the only way that you can know what investments will do in the short run is if they're very, very safe, which means you're not going to get much in return. If we have money that we know we're not going to spend for a long time, let's take some strategy with that so that it will grow big enough, more than inflation, over and above inflation, and give us the advantage that we need to pay for our expenses in our later years. Now, how do I know that we can do that? Well, number one, I don't know. Nothing is guaranteed here, but let me walk you through my thinking of building this long-term portfolio. If we look at stocks and how stocks have performed over the past nearly 100 years, here's what we have. And if we look at every annual return, 3 times out of 4, 75% of the time, the market goes up over the course of a year period. That's pretty good, right? 3 times out of 4. We look at 5 years, it's 88 times out of 100, almost 9 times out of 10. So if we have things that we know we're going to spend money on in the next 3 or 4 years, let's not take the risk that it's going to drop between now and then. Let's keep that on the sidelines. But if we know we have long-term money and we know we're not going to spend it for 5, 10, 15 or more years, then let's put it to work for us. And we're going to put it to work in what I call the great businesses of the world. And I'm going to talk a little bit more about that in a moment. But this is not, I would guess that most people would agree that we can't predict what the market's going to do in the short term, and we should invest for the long term, and all of that sounds really good. But that's not usually how we behave. What we normally do is we normally try to predict the future. Probably looking at the markets today, yesterday, and the day before, and all this volatility, we probably have some sense or feel like we know what's going to happen tomorrow. Well, guess what? You don't. Nobody does. So we can't predict the future. The other things that people do are they act on impulse or react to their emotions. I'm going to talk a little bit more about that on the next slide. Or they react to like tips or hunches, something they saw on the news or something their friends said. That's no good. The media is the worst culprit. The media, the financial media in particular, if you look at the financial media, they're funded by big Wall Street firms. That's who advertises on the financial media. And those big Wall Street firms only make money if you do something. So they're all kind of in cahoots trying to get you to do something, when often the best thing is to do nothing, to put together a good long-term portfolio and hold on to it. But that's really hard to do, because we go through this emotional roller coaster with the markets. Now, over here, when the markets are going up, we might get to feeling optimistic and feeling good about them. And then when they get really high, we get elated, we feel great about them, right? When they've gone up so much in recent years. When they start to fall like they are now, maybe we get nervous, or maybe we're even fearful after they've fallen. And then the optimism comes back only after the markets come up. Now, let's look at this again. Think about this. If you're feeling optimistic or elated, what are you doing in this period? You're feeling really good. If you're acting on your emotions, you're probably buying. You're probably investing in the markets. And then as they drop and you get nervous and fearful, guess what you're doing down here? You're selling. So you're buying high and you're selling low. Exactly the opposite of what you're supposed to do. But it's what we all are inclined to do and what our emotions push us to do. And so investing with our emotions in that way is no good. We need a long-term philosophy and strategy to get us where we want to be. And I call it investment philosophy. The philosophy has two requisites. One, it's true in all seasons. No matter what's going on in the markets, no matter what's going on in the economy, this philosophy remains true. And then the second thing is the philosophy has to be translated into an actual investment strategy. Now, the next several slides, I'm going to walk you through my investment philosophy, and I hope it makes sense to you. But even if you don't use mine, you should have your own that follows this pattern, true in all seasons, and creates an investment strategy that works long term. All right, so here's mine. So I believe in something called the wisdom of the crowd. And here's an example, one of the earliest examples from the statistician, Francis Galton, 1906, went to the fair in Plymouth in the UK. There was a farmer there who was going to give away an ox to the person who could get closest to guessing the weight of the ox. And the statistician knew about this, took all the guesses, did all kinds of statistical analysis. But what he found, very interesting, was that the average guess was almost exactly the weight of the ox. The person who won the ox was not closer than the average. So the average was really the winner. But of course, you couldn't divide it up and give it to the average, right? Couldn't give it a little piece to everybody. What we're looking at here is the knowledge in all of those guesses accumulated, put together, taken by average, was smarter, was more intelligent, was more correct than any individual guess. That's the wisdom of the crowd. Now, this happens all the time with those jelly bean jars that you see where they say, guess the number of jelly beans or any of these. There's a number of studies out there, not studies, but a number of results you can look at, and the average is almost always very close to the real thing, when the range can be quite wide. Now, what does that have to do with investing? Well, guess what's happening every day in the markets? Some $400 or $500 billion is trading hands every day. Those are all guesses of individual buyers and sellers saying, I believe the stock should go up, I believe the stock should go down. Now, if you're going to take a stand on an individual stock or a group of stocks and say, I think these are going up and I think these are going down, you are betting against all of that money, that $500 billion a day that's going to work every day. You're saying you're smarter than all of that. And I just don't believe that's the case. And there's been no statistically significant record of any professional fund manager to be able to do this. So I say, why bother? Why would we try to play a game that's rigged against us? Let's not do that. Instead, let's do something else. Now, what are we doing? We're investing in companies, actual real companies with boards of directors and CEOs and employees Those companies exist to make money. That's why they're there. They offer goods and services that are in demand, and the cost is affordable to the customers and also leaves profit for the company. So you've got three distinct groups there. You've got the customers that say, yes, I'll buy that for that price. You've got the employees that say, yes, I'll work there for that pay. And you've got the company which says, yes, we'll go forward with this strategy as long as we can earn a profit. Now, we're the owners of those companies, so we're getting a piece of that profit. Companies, if you think about it in this way, they exist to connect people and their efforts in exchange for a small slice of profit. They connect the workers with the customers and, of course, the owners, and the profit goes to the owners. So here's my investment philosophy. Humans are designed to connect with each other. Since the first two cavemen got together and said, I'll hunt, you fish, and we'll both eat well, we like to commune with each other and work with each other. And of course, through COVID, we've experienced the opposite of that. And it's been very disruptive emotionally in all kinds of ways. So I believe humans are designed to connect with each other more and more. Companies are designed to enable those connections, and they stand in between humans, employees, customers, and in order to make those connections happen. And in exchange for that service, the company earns a tiny profit. Now, we don't know which companies are going to do better, and we don't know when, or this sector is going to go up and that sector is going to go down. We don't know any of that. So we're going to own them all. We're going to own all publicly traded companies that we can, keeping our costs low, and also retaining simplicity in our portfolio. We're going to do it through mutual funds. That's what I do. So that's the philosophy. Now, for this philosophy to work, there's three principles, three things that you, the investor, have to follow. Number one, you have to have faith in the future, because like times like now, the markets get bumpy, the outlook gets dim, and we feel things are bad. You have to have faith in the future in the sense that you have to know that things will get better, but you don't know how they're going to get better. You have to have that faith. That's what faith is. You know they're going to get better, but you can't see the path how. You just know that they will. You have to have patience. We don't know when things will get better. We don't know when things will recover, but we know that they will. And since we're long-term investors, we believe we can hold out for that long-term reward. And then third is discipline. We can't be distracted by all of the fly-by-night strategies, all the things, shiny little objects out there that are come and go, because they do come and go. What we're doing is we're implementing a strategy that's worked for over 100 years. We're not implementing a strategy that was invented yesterday and seems to have worked over the last 6 months. Then there's three portfolio practices. This is actually, within the portfolio, what do we have to do? Well, we have to have an asset allocation, a structure that you can survive the crashes with, because we're going to put together a portfolio and we're going to ride the markets up and down. We can't have the markets go down so far that it blows us up, either emotionally or in reality with the expenses that we have. We also have to have diversification so that we know that we're going to get the average of the market. Portfolios I put together have about 10,000 companies in them. That's a lot more than the S&P 500, which has 500 companies in them. So we went wide diversification. And then rebalancing, we have to manage as we go forward. If we want 30% in large stocks, we've got to actually do trades to get back to 30%, because remember, these numbers are moving every day. Now, how do we lose in this strategy? Here's how we lose. If we put together a portfolio that when it crashes, so here's what's going on today, that it's too much and we can't take it and we have to sell out. We lose in two ways if that happens. Number one, let's just look at 2008, 2009. Let's say we get down here and we can't take it and we sell. Well, guess what? You've just locked in your portfolio there. You've gone to cash or something safe, and that's after your portfolio has dropped by 20, 30, 40%. You've locked in. So that's the way most people think of a loss. But here's the worst part. Look at the gains. The gains almost always come after the downturns. So we have to be able to ride through the crashes in order to get the gains on the other side, so that we even out and get our 7, 8, 9, 10% return over time. Now, how often does this happen? Well, it doesn't look like it's that often here. This is a 20-year chart, but the reality is, look at these red dots here. These red dots say during each year, how far did the market drop from its high? So far this year, the market's already fallen 13% from the high. In 2020, during the COVID crisis, we were down 34% at one point during the year. Now, if you look at 2020 from January to December, it was up 16%. So if you closed your eyes and didn't pay attention for those 12 months, you earned 16%. That's what we're talking about by being a long-term investor, although usually much longer than a year. But if you watched it and been concentrated on it and let it affect you and let it create your strategy by reacting to the markets, it's quite likely you would have sold and locked in this loss and missed the subsequent recovery. We don't want to do that. So why are we long-term investors? Because stocks go up over time. All these things, some of these are, some pretty bad things, wars and global financial crisis and all that. But the stock market keeps going up because we have humans working in our companies trying to make money for us. Let's look at this. Okay. In our investment philosophy. So here's how the stock market has behaved. So if you were, let's just say you were born January 1st, 1980. If you were, then today you are 42 years old. On your birth date, the S&P 500 was at 89. That's where the index was. Today, it's at 4132. If you had put $10,000 in on the day you were born, or probably your parents would have to do that, right? You probably didn't make $10,000 the day you were born, unless you're some kind of supermodel. But if you put $10,000 in and didn't touch it, went away without looking at it, you'd have $1.1 million today. That's a 12% return over time, 12% annual return over time. Now, some years you made 40%, some years you lost 40%, but over time, over the long time, 12%. That's a fantastic return when you look at all the other alternatives that people look at, like real estate or gold. Even inflation was only up 3% per year. So that means you were able to buy so many more things today than you were back then. This is why this works. We're capturing the value of human ingenuity. With all of these companies we own, those humans are getting up every morning trying to make money for us. Now, you might say, okay, well, that's fine for that one time period, but what if I bought at a bad time? What if I was a dumb buyer? And so this is an analysis I update from time to time. And what I call this is the last dumb buyer. So who is the last dumb buyer? Well, that's the person who bought stocks right before the crash in 07, 08. So October 9th, 07, that was the peak. The S&P 500 was 1565. And we're saying we bought stocks on that day, the absolute worst day. Well, again, the current index is 4168. That's as of May 5th today. This person would have made 7% without dividends. With dividends, this person made 9%. So the worst buyer of stocks in the last 20 or so years made 9% per year. That's the worst you could do if you bought and held. You can do a lot worse if you're buying, selling, buying, selling, buying, selling, and paying attention to your emotions. So don't do that. We want to invest for the long run. Now, I mentioned that we need to structure a portfolio. I'm at my 20 minutes and I'm going over. I'm sorry. I'm going to have to go over a couple of minutes. So we mentioned that we need to structure a portfolio we can survive. So we've got several different portfolios that range in risk, from very conservative to very aggressive. These are actual funds that I recommend to my clients who manage their own money. I have clients that manage their own money. I have clients that I manage their money. So for clients who manage their own money, we just use these 3 different funds, Vanguard funds. Here's the percentages. You got to figure out which of these buckets you're in, of course. But once you figure that out, you got the percentage and you can just manage it from there. I do want to show you my personal portfolio and the portfolio I use for my clients. This is for an aggressive strategy. So this would be this column here, this aggressive column. That's where I and my wife land out on risk. And when I manage the portfolio, I get a little bit more detailed, buy some additional funds. These are all index-like funds, very similar to, there's nobody waking up in the morning saying buy Coke and sell Pepsi. This is all just, 10,000 companies around the world. And I use dimensional fund advisors. Don't really want to go into an advertisement for them. That I'm already over time. So the big question for I think once you understand the philosophy, once you get tied into that, is which of these strategies is right for me. And I'm going to give you a little link in the chat here to do a risk tolerance exercise that I do with clients. And when you do that, it's going to send me your risk tolerance, and I'll reach out to you and we can have a conversation about that if you want. If not, you can just do the risk tolerance test and take it for what it is. So let me just be quiet and type so that I can, yeah, there it is. So that's the link. Go and take that link or click that link, take the risk tolerance. I'll reach out. And if you want to have a conversation, I'm happy to do that. Also, as I mentioned, you get a free coaching session for attending today, a $300 value. We can talk about this topic or anything else, whatever you want to talk about. I'm going to put the link in for that. I can't type and talk at the same time. So that second link is the link to simply schedule time with me. Be happy to have a conversation with you about this or any other topic. So that's the webinar for today. Some other resources out there. I do have a podcast, very short episodes, 2 minutes. Deliberate Money Moves is the name of it, and my blog there. You can always email me if you have questions. Our next webinar is going to be called How to Reduce Your Taxes. It's on June 9th. You can, tomorrow you'll get an email from me with a replay of this webinar, these slides, and a link to schedule for the next webinar, to register for the next webinar. Even if you can't attend, go ahead and register and you'll get the replay, and you'll be able to watch it there. Just a little disclaimer, this is not financial advice. Financial advice is specific to you and your situation. I can't give you specific advice on this format, of course, because I don't know you. I don't know your situation. So I can only give advice to my clients, and happy to talk to you about that if you'd like. So, and there's the final disclosure. So I'm going to leave this up here. And again, happy to answer any questions about the things we talked about today or anything else financial. Happy to do that. Let me just check to see if there are any questions. Not seeing any questions at this time. If you have a question, just throw it in the chat or the Q&A. Otherwise, I will let you get on with your Thursday. Nope, not seeing any questions. So thank you so much for joining. I really appreciate it. Again, look for that email, register for next month's webinar. And if you do have some questions that come up, just shoot me an email. Happy to connect. Take care.